This is our third lesson on insurance. Quickly just showing again what I covered the last day. Last day we looked at calculating insurance premiums. We know that an actuary is the person who does that. That's the profession for someone who calculates premiums. There are the different factors, the risk, claims in the past by you or other people, value of the item you're insuring. The loadings may be extra policies they might add on, or extra risks that are potentially present for that person for the policy, and they'll add on costs. Obviously ways you can get a discount on your insurance. Different steps. The first four are to do with actually getting your insurance, contacting an insurance agent or broker, completing the proposal form, which is your application form. You have your premium, which is the amount you pay, calculated again by the actuary, and the policy is then issued to the customer detailing the information regarding their insurance, the legal information regarding their insurance. Step 5 is if an actual loss occurs and you're claiming insurance, first you need to go through the claim form, stating all your details and stating what happened, black and white kind of form, so they can kind of come back to it. The insurance claim is step 5, and 6 is receiving compensation. Different types of insurance, we'll look at these a little closer. We've household on the left, business on the right, and in the center there obviously we have commonalities between two. We'll be looking at them in a little bit more detail. So similarities, this might not seem like much, but for some reason it's a common question for the Leaving Cert. I'm not too sure why, but it does seem to come up a bit, just to kind of compare the two, household and business insurance. So remember, household insurance is basically you getting insurance for yourself. It's not, well, obviously it includes home insurance, insuring your house against flood, fire, and things like that. But it includes that, but it's many more things. It also includes any form of personal insurance, or even your car insurance, or anything like that. So household is just to do with you as an individual, not necessarily just your house. Business insurance obviously is insurance that any business would acquire. So there is 4 different headings there for what we've looked at there for the slide above, when we looked at what's common between the two, and we're focusing on these a little bit more, obviously more the common ones. To be honest, the first 3 I would say are you should have a decent understanding of those anyway, so I wouldn't say they're anything new. Property or your premise insurance, property generally being your house, and usually a business would refer to their their ownership of their places, their premise. So that's generally what we use premise for. Kind of more an American term as well. So the covers the home obviously against natural disasters. That's what your house insurance is. And for the business, it covers the business again in the event of damage or fire, or generally some form of a break-in. So that's your property or premise insurance. Again, it's just actually covering the physical building itself. So if the walls, the roof, any form of the structure of the house is destroyed, that's what property insurance is covering. And usually it's a natural disaster, some form of a storm or flood or something like that, or a fire. Contents insurance is different. Contents insurance insures the actual physical items in the house, and prior to getting your contents insured for your house, there'll be a valuation placed on the stuff you own, and how much all that would come to in terms of its valuation. So for contents insurance, obviously for personal, it's household, your furniture, electrical goods insured against, again, your fire, flood, but theft as well, obviously, because generally, it's more common, obviously, for your items to be stolen rather than somebody trying to physically steal a building, apart from ATMs. they're still an item anyway. Contents, so you're looking at generally it's whatever you own that you would be seen as some way valuable. I would say um, jewelry and electrical items would probably be the biggest two, along with some furniture, and you're just basically evaluation of how much they are worth. And you then pay insurance, and if you have that stuff destroyed or stolen, then the insurance company can pay out and you'll receive compensation. For a business, generally it's the same, but generally the price can be much more, because obviously a business generally might own a lot of furniture, a lot more electrical goods, depending on how big the business is. So they'll obviously insure their contents as well, again against some form of damage or theft or anything like that. You'll often find for a form of a supermarket that obviously their contents of their stock, let's say the Centra, can have their contents insured as well for their insurance. But for them, the most important part would be maybe the money in the till and alcohol, uh, cigarettes, things like that. Nobody goes into a shop, I would say, and steals tins of beans and loaves of bread. It's usually kind of the items that you can take and resell. So it's usually alcohol, cigarettes, and cash that are stolen when people break into a shop. So you'll often find that they might be strategic as to what they insure. Um, Motor insurance is legal. It's illegal to drive without it. You can't take to the road without insurance. So everybody's supposed to have it. For your household, it's your car, obviously, or whatever you're driving. And for the business, generally, it's a lot of delivery vans or company cars. Um, the business and households alike all have to insure their cars, delivery vans, whatever form of motor vehicle they're traveling in. The final one, I'm going to get you to take down the final one. If you're not too sure as to what contents insurance are, you can take down that row as well. But if you're familiar with it, you can leave it out if needs be. The fourth one there, I'll get you to take that down. PRSI, pay-related social insurance. Employees pay PRSI from their gross pay, and it's used by governments to pay for items including job seekers' allowance and state pensions. It's used for any form of social welfare, even stuff like the pandemic unemployment payment. That is the correct term for the payment that people are receiving for basically the COVID payment, a pandemic unemployment payment, um, and even collecting people's PRSI, and that's generally where that money goes. You're actually paying for other people's social welfare and for your own. Businesses will pay it as well. Your employers pay PRSI on behalf of each of their employees, and it's known as employers PRSI. So obviously pay-related social insurance obviously falls under both categories as well. It's related to wage, so it comes out of your wage. We've similarities and we've differences. Again, just this is a common question. It's similar to the one above with similarities. So for policies between household and business insurance, it can take out a common type of insurance. And again, I've gone through motor contents and pay-related social insurance already. Both forms, you still have to obviously be completely truthful. The utmost good faith applies to both. This is just the same, highlighting what's similar between household and business insurance. Risk management, there's generally some forms of safety features that would need to be installed or looked after if you're getting insurance. I might have said before that, hotels and things like that will still have to employ their security even though nobody is in the hotel, because it's on their insurance contract. So it's a form of risk management. And review policies, again, like anything, you're generally to stay up to date and review policies and maybe change your insurance policy depending on if there's any factors that have changed. For example, if I had a job as a teacher living across the way from the school and I changed my job to a delivery driver, it is up to me to now review my policy and change it. Otherwise, it may not actually stand in the event of an accident. If I've told the insurance company that I'm living across the way from the school and I'm a driver, I just drive to school and that's about the size of it. I'm not paying that much. And if it comes out then that, I'm actually doing deliveries for a company, the insurance company probably will not pay me. So it's up to me to review my policy. Differences. Okay, so risks, exposed to a greater number of risks for businesses than household. Generally, obviously, a business is much bigger. If you think of any form of a shop or anything like that, people that have offices, generally, there's much more items. There's, you know, a larger area, and there's much more valuable items for a business than there would be a household. So the risks might be assessed differently. Businesses generally tend to pay more than households, again, for the same reasons I've stated above. Households pay PRSI in their own earned income. Everybody pays PRSI on the income they earn, but obviously, if, as we said in the last slide, a business must pay PRSI for all its employees. So for every time a business takes on an employee, they also have to pay some form of PRSI on that too. And fourth and final, business expense. The cost of insurance is a business expense that can be used to reduce the firm's tax liability. Insurance is encouraged for businesses to get as much, to be as, I suppose, to get as much insurance cover as you can. So what we do there basically is you can get some form of tax relief as a business, and that if you pay into getting insurance, some of that money may not be taxed. Tax reliefs are there to encourage people to engage in a form of action. For example, your pension is not taxed. And the reason your pension is not taxed is because they encourage you to pay into a pension. So for businesses, their insurance, not all of it, but some of it, can be used to reduce their tax liability, i.e. reduce how much tax they owe, because businesses are encouraged. We reduce tax for things that we try to encourage, pensions, business insurance, and we increase tax for things that we want to discourage, alcohol and cigarettes. Importance of insurance. So 4 different headings. Cost savings. Cost of a premium is usually less than the cost incurred if the risk happens, and that should be quite obvious that if you are paying whatever, €1,000 a year for insurance for your car, and your car is valued at €12,000, in the event of you crashing that car, you'll be very happy that you paid that $1,000. Generally for households and things like that, obviously you can save up your whole life, pay for a mortgage, and it's more or less a lot of your maybe about a fifth of your entire earnings in your life, or a quarter of your entire earnings in your life, will go towards paying your house. And obviously if you lose that, if it's burned to the ground, it's tough to get back up after that. So you'll be quite happy that you'll have paid a lower premium compared to the damages you'd pay. Legal requirements are for motor insurance. You're not allowed to drive without motor insurance. Sorry, there's only 3 headings here. The third one is risk management. Insurance help households and business to reduce their risk as much by carrying out a risk assessment, and that's quite similar to that first slide I showed there, where there's a million and one things wrong happening in that business. And obviously, as a risk assessment, you might have somebody coming into that business and just looking around the place and saying, okay, so you have this blocking the emergency exit here. They do this in school as well. If you notice in the classroom, for any room that would have an emergency exit, there is no table and chairs directly in front of that emergency exit, because it would be seen as having poor risk assessment. And obviously things here like, you're never going to have a wire going across the floor of a room. So the importance of insurance, cost saving, legal requirements, and risk management, as stated. Now, what I want to go through here is calculating house premiums. So if you're calculating insurance for your house, how do you do that? So there's an example here. Margaret Finley's house insurance is due for renewal. Her house insurance is up and she's to renegotiate. Her insurance company has given her a quote of €12 per €10,000 value for the house, and €20 per €5,000 value for the contents. So she's insuring her physical house, and she's insuring the contents, the electrical items, jewellery and furniture, whatnot, in her house. She estimates that she should insure her house for 180 grand and her contents for 90,000. Calculate the insurance premium that Margaret will have to pay. So what we're looking at here is, you have an individual, her house is worth 180,000 and the contents inside her house are worth half that, 90,000, and she's trying to pay for house insurance. So she's trying to figure out how much should I pay? So what the insurance company are doing is they're telling her, for every 10,000 euro value for your house, you pay us 12 euro. So if her house is valued at 10,000 euro, she'd be paying 12 euro insurance. But obviously it's not. It's worth 18 times that. So her house is 180,000 euro worth. So how many times will she pay 12 euro over? And there's just a simple, I wouldn't say formula, but there's a simple way in which we can kind of go about obtaining that number in terms of how much will her premium be, how much will she pay. For her contents, what we're saying here again is that for every 5,000 euro value she has for contents, she'll pay 20 euro insurance. Contents is usually much higher, as I said, because the only time you'll probably have somebody claiming insurance for their physical house is if there's a fire, flood, or any form of natural disaster that damages the building or the roof or something like that. Whereas for contents, I mean, anybody can, smash your window, go in and take her TV. So it's much more likely that there could be an issue over your contents being stolen or damaged compared to your physical house. Depending on where you live. But the 5,000 euro, so every 5,000 euro that she has in her contents, valuation for her contents, she'll pay 20 euro. But her total contents are 90,000 euro. They're not 5,000, so she's not going to pay 20. She's going to pay many more times that. How do we figure out how much she's to pay for insurance? Again, her premium is the amount she pays. So if we're looking at this here, her house is valued at 180,000. So I'm putting the 180,000 on top and I'm dividing it by 10,000 because I want to see how many times 10,000 goes into 180,000, because if she has a valuation of 10,000, she pays 12, but her house is valued at 180,000. So how much will she pay? I'm multiplying that then by 12, and that's what you're doing the whole time. You're putting the actual value of the asset, you're dividing it by the per value figure. So the per value figure is per every 10,000, and then you're multiplying it by how much she will pay. She'll pay 12 euro for every 10,000. So her house is worth 180,000. How much is she going to pay? 216 euro. Again, the exact same thing. If her contents are valued at 90,000 euro, and for every 5,000 euro in contents, she pays 20 euro. I put again 90,000 divided by the 5,000 multiplied by 20. The valuation of her contents divided by the per valuation figure multiplied by the cost per valuation figure. And that gets me 360 euro for contents, 216 for house, 360 for contents. If I add the total up, I find her total premium, how much Margaret will pay for insuring her house and her contents. And we can see that to be 576 euro per year. Now obviously that's not a whole lot of money, considering that her house and her contents add up to 270,000 euro valuation, that if they were to be completely destroyed, she'd lose just over $250,000, and she only has to pay 576 euro for insurance for the year. So the insurance generally isn't as expensive. For motor insurance, it's much more expensive because the likelihood of claiming is much higher. So again, what have we done? We've put the valuation of the house, or the valuation of the contents, divided by the per value figure multiplied by the actual cost per value figure. And it's always the same. The big number divided by the per figure multiplied by the cost per value figure. So that's that calculation. I'm going to quickly go through another one here just to kind of make sure that we have a good understanding, and I'll give you a question similar to this for homework. So Reese is looking for a new house insurance. He has some expensive sports equipment but will need to be insured separately because of its specialist nature. Buildings, general contents and sports equipment. Buildings are worth 450 grand, contents 110 grand, and sports equipment 3 grand. So he receives two different valuations, one from Insure for All, or Insure All, and the other for Cover for You. So Insure All charges €50 per €1,000 for the building, and €5 per 1,000 for the contents, and €20 per 1,000 for the sports equipment. Cover for You charges €35 per 1,000 for the buildings, $450 for the contents for 1,000, and a flat value of 120 for sports equipment up to the value of 5,000. And the task here would be to find which insurance company offers the best value for money. So whichever insurance company offers, the value, whichever one is cheaper, basically. So again, do you know what I'm going to get you to do it, just because this is rolling on to 20 minutes. So this will be your homework. We have two different companies. Per €1,000 for the building, you pay 150. So their building isn't worth 1,000, it's worth 450,000. So you have to find how much you'll pay for the buildings. So that's your first one. How much you'll pay for buildings. Then how much you'll pay for contents. Per every 1,000 you pay €5. So there's 110,000. Again, you can see in the last slide we have that formula for calculating. For the cover for you, the contents or the sports equipment is obviously the same, and the first two here are the same. The third one here for cover for you is just a flat rate of €120 for sports equipment up to the value of 5,000. That means that the insurance company is telling you that, look, if you have sports equipment and it's up to the value of 5,000, you pay €120 on it. And if their sports equipment is 3,000, therefore how much will they pay for their flat rate for insurance for their sports equipment? So I'm going to get you to do this out for homework. You have the two different insurance companies. Calculate how much they will cost for house, contents, sports equipment for both. Add up the total costs and tell me whichever insurance company offers the best value for money. That's our work for now.